It is March 19th. Market Mumbles. I'm going to do the part two of the indicator series that I use for Bitcoin. Now, the previous indicators were all indicators that left regions to be marked out and ranges and things like that on the chart. These other indicators are less about direct interaction with price and more about measuring averages and detecting breakouts or deviations. So I'm just going to go through them, explain how I look at them, how I use them, and how these other indicators give me a sense of when I am increasing my attention towards one particular bias. The first one will be on balance volume. This indicator I typically look at on the daily and on the weekly. This one will typically have action similar to price action with trends that establish over time. What you're looking for with this one is a breakout to either direction. So we can see here on the daily and on the weekly, there's nothing breaking out to either side, so it doesn't have me paying extra attention to bias in one direction or the other. Accumulation distribution, looking at it on the long time frame, we recently had a break to the outside of that, and at the same time we had that break, we also had a pretty steep drop. So there's our break, and then not too long after that we had a pretty big drop. That could have been part of someone's strategy to short or sell before lower levels were reached. On the daily side, we have a pretty defined channel, and I don't see breakage to either top or bottom for that one. The stock RSI. Now, this is an oscillator, unlike the on balance volume and accumulation distribution, which can chart upward or downward, just depending purely on the amount of volume. The oscillators, they only move to the extremes of their range, and then they typically swing back in the other direction when you have some sort of price action that is going to change the direction. Often very useful on the high time frame. This is a crossing oscillator, so when you have the blue line on top, that signals bullish momentum. Prices are rising. But then you kind of get up to the high end of the zone, and when you see that cross, and then the orange ends up being the one on top, that's a good time to look and say, oh, what's about to happen next? And it wasn't too long before we had a significant drop down. But now that we are in this drop down, we once again have a cross. So that suggests that on the weekly scale, we may be looking for a swing up. The MACD is similar to the stock RSI in that it has the two bands that when they cross, that's usually some sort of signal. You can see the stock RSI gave an earlier signal than the MACD here, and the MACD gave a decently timely signal before we hit that last drop. MACD has a histogram, which basically just represents the width between the two moving averages. Now you can set what you want your moving averages to be, and typically most people are using 12 and 26, but that will also kind of give you a visual representation of the strength of the trend. Awesome Oscillator is another one where you don't see the two bands, you just see the histogram. It's also similar to the MACD in that way, but it's using slightly different calculations. Awesome Oscillator is one where you will also look for divergences. So this high followed by a lower high. Now up here we had a high followed by a very slightly higher high. So that kind of divergence is a signal that the price action looks like it's going up, but something else looks like it's going down. course, that's followed up with this downward price action. Now, RSI is a very commonly used one, especially for divergences. The RSI, the money flow index, and the stochastic RSI all provide some sort of signal at the extremity of their range. It's saying at the high end of the range, this could be a good time to sell because your asset is overbought. And when you're at the low end of the range, it might be a good time to buy because your asset is oversold. Who defines over? I don't know. But what matters is that a lot of people looking at it will start to apply that to their own bias. Anyway, going back to the RSI and the MFI, the money flow index. With the RSI, it also matters if you've recently touched the middle. So if you looked at a divergence and it ends up touching the middle, technically this divergence here wouldn't be considered valid because it has touched the middle before the divergence played out. At any rate, I hope all that indicator stuff was infotaining for you, and in the future I will probably just read off what changes, if any, are worth noting as we go week to week.